Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, we're back here on the Investor Coaching Show. Paul Winkler, paulwinkler.com. Article pops up. Why Eugene Fama warned Bitcoin could become worthless within 10 years. Probability close to 100%. Fama was the Nobel Prize winner in 2013. I spent a lot of time working with him and his son, as a matter of fact, years and years ago. Fama argues Bitcoin fails fundamental monetary principles. Its extreme volatility prevents it from functioning as a reliable medium of exchange or store of value. Other top economists echo similar warnings, including Paul Krugman, Robert Shiller, Nouriel Roubini, Kenneth Rogoff, John Quiggin. Gosh, some of these names I can't even pronounce. I'm not going to even try. Economists highlight Bitcoin's limited use as a form of real-world money, noting its minimal adoption for payments compared to its speculative trading volume. And that's interesting. We'll just see. Anyway, I'm not going to invest in it. You just don't even care. So another topic, real quick here. I was going to hit this, and go ahead. You, Evan, pick something.
Oh, well, this falls into the category of A, why it's difficult to stock pick,
okay,
and B, when companies have adversity, they're going to find a way to increase profitability. They're not going to just sit still and say, okay, well, gee, this stinks. We're going to go out of business.
All right.
And so in 2007, McDonald's had done some research on their milkshake sales. And they found that 51%, I think it was, of their milkshakes were sold before 10 a.m. And they were a single purchase.
51% before 10 a.m.
And that was the only item that was purchased.
And they weren't made from polluted lakes, right?
No.
No, you remember that when you were kids? Oh, you probably don't even remember
McDonald's
that.
is my kind of place.
Yeah. I'm going to see in your face. French fries between your toes.
So
pickles up your nose.
they were trying to figure out, they're like, well, this is the only item they're ordering. And, they track their break even.
Really?
All these corporations research all this stuff. But
that's funny.
So they're like, okay, well, why and how can we increase the sale of our milkshakes? And, they tried various surveys and they just weren't getting any information. And so they hired a group, and I forget the name of the corporation, but Clay Christensen and Bob Moesta were the principal researchers or crafting this project. And so they basically had someone stand outside the drive-thru after one of these people had bought a milkshake. They, like the cashier hit a buzzer and said, "Hey, this is this person that just bought a milkshake."
Yeah, there you go.
And they would ask him one question. It was basically, why did you buy a milkshake at
this time
8:30 in the morning
instead of a cup of coffee?
And that's it.
Yeah.
Well, way back then, a cup of coffee we didn't have as many cup holders and stuff back then.
Okay.
And so some of that was different, but the coffee would cool off and they drank it too fast, and a milkshake would last long enough on a long commute, regardless if they were blue collar, white collar, the demographics didn't matter, but it was basically a companion. Ultimately, the answer was, it's something that I can touch and enjoy the entire commute. It stays as thick as it was, 30 minutes ago and so forth. So fast forward, they crunch all of this data, and now McDonald's sells more milkshakes than anyone in the world, but we now call it McCafe. And they found out that
they call it
McCafe is their frappes, the fancy coffee, basically.
Oh, okay.
That grew out of, we're just going to put caffeine in the milkshakes, basically.
Oh, seriously.
And now people are getting this kickstart with and so interesting, so then if McDonald's, is the largest purveyor now of milkshakes, certainly before 10 o'clock, Guess who the second largest purveyor of milkshakes is with that
Starbucks.
Starbucks.
Is it really? I didn't know.
And so,
I had no clue.
We call it coffee with cream and chocolate and all this, but it's basically a milkshake with a shot of espresso or something.
Oh, that's funny.
It became a hugely profitable thing, rolled out for years. They had done this, I think, in Australia first, and then rolled it out to the States. But all of that grew out of studying what's the job. The concept is called "What's the job to be done?" In terms of making a purchase. What were these people? What was the job they wanted the milkshake to do?
Well, see, it's funny that this reminds me a lot of when people ask me about individual stocks and why I don't like holding individual companies at all. And, the study that we talk about in the workshop where you take the S&P 500, the average company stayed in the S&P 500 for like 60 years. And in recent history, it's down to 18 years. And that's it.
That's interesting.
So companies don't last as long as they used to.
Yeah.
Why? Well, a lot of it comes down to the fact that it is a lot easier nowadays to replicate somebody else's business model.
Yes.
And to look at what they're doing and go, hey, what's working for them? And the access to information. And the beauty of this is that if we look at the stock market, as a whole, owning all companies and the level of volatility, the ups and downs in the stock market, it is no more volatile today than it has ever been. I mean, there are periods of time where it's a little bit more volatile if you take short periods of time. But if you look at the overall long-term volatility of the stock market, it's no higher. Yeah. But individual companies are a whole lot more volatile. They come and go much more rapidly. So that's another reason we don't want to do that, because you're taking risks that you don't get paid to take when you own individual stocks. The expected return of any company, let's say you have any company that's a big U.S. company and that company, the risk level is such that they sell for 16 times earnings. Well, the expected return is the same between all these companies, but the volatility that one company will go away and another company will take its place or whatever is so significant that I don't want to own individual stocks. This is a perfect case in point of that. You have one company that comes up with something and says, hey, milkshakes before 10 o'clock in the morning. And then another company goes, hey, that does sound like a good idea. We could do the same thing. We replicate it. It's not something that's hidden for years and years on end. And it's the same thing with AI. Look at these companies just fighting all over themselves to be first in that particular area. We didn't know in the late 90s. That was tech stocks. You have that competition between various companies. And nobody really knew which companies were going to be the winners in that race. Nobody knew which companies would come out ahead of others. So you had a lot of companies that just ended up becoming worthless. Yeah. And when the tech stock declined, you had an 80% decline in that market. People forget in the late 90s, people thought the sky was the limit. This is going to go on forever. This is going to be great. It's going to be wonderful. And I think that goes with any investment that you look at. And wow, look at what this has done in the past. Look how great it's been. And I always tell people, take it with a grain of salt. You don't know when all of a sudden something's going to change, and that thing that you think is the bomb, that you think is the answer. And we often use the example of Kodak and digital cameras. They invented the digital camera, and nobody owns one now because other companies came with much better digital cameras, and they took over the market. If you look at phones, the company that invented this cell phone, Motorola, nobody owns a Motorola cell phone. Nobody has one of those things anymore. But anyway.
A name popped into my head as you were talking about the late 90s.
I saw you over the researching.
And so I Googled pets.com.
That's exactly the name that went in my head as well.
Of course, yes. When I first did pets.com, it just said no web page.
Right.
And so I put in pets.com stock price. And so, it was a .com enterprise, obviously focused on pet supplies and stuff in San Francisco. Right. But founded November 1998, defunct November 9th, 2000.
Wow, that
it only
didn't take
lasted
long.
like 2 years, and so I don't know how much capital it consumed. But it's too easy to compete with some of these things, and the emperor eventually has no clothes.
Yeah, and that is exactly it. And people's tastes they're just all over the place. You don't know when something is going to be a fad and people are really excited about it. And then all of a sudden, a lot of people say that the reason that gold has gone up. I mean, I almost hate going back to the Bitcoin thing again, but I feel like I have to.
Let's poke the bear.
But a lot of people have gone away from Bitcoin. As people say that the reason gold went up is because people are going away from Bitcoin.
Yeah. And
they're going to the next speculative thing. And we've seen that with meme stocks. One stock will be really, really popular for a while, and then all of a sudden, it seems like the sky is the limit for it. And then all of a sudden, people go, the taste change. Boring. Moving on to the next thing.
Right.
And I think that is I think this is a critical thing. Evan, you started to talk about this before we even started the show. So let me hit this. I've been seeing a lot of commercials recently. And the commercials have been for educating younger people because there is going to be this huge transfer of wealth. And this one company says, hey, we need to make sure that the adults, these people that own all the wealth right now, the older people, that they're making sure that they're engaging their kids in an education process. Because if you don't engage your kids, you have been building up this wealth forever, trying to put together a good nest egg for your kids, and you don't know whether your kids are just going to squander it on the next fad that comes along. Because they don't understand these concepts of cost of capital. They don't understand, that, stock picking is a destructive method of managing money. They don't understand that choosing investments based on past performance, because markets go up and go down, you're typically buying high. They don't understand that commodities are not good long-term investments that would only have a rate of return, historically, even the best ones, of the inflation rate. They need to understand how things work so that they don't get taken advantage of, because Wall Street will take advantage of you. I'm going to tell you history.
Yeah.
Tell you my history. Limited partnerships.
Oh, yeah.
Oil and gas, limited partnerships.
Yes.
Real estate investment trusts.
Yes.
You had IPOs. We were pushed heavily to try to get people into those types of things.
That I never did.
You never did that. I didn't sell it either. I was too analytical to sell something that I didn't understand completely and didn't feel like I could totally get behind.
Yeah.
Tech stocks in the late 90s. You look at real estate, the push for real estate was in the early 2000s. And then, not too long ago, we actually had the same thing happen again. Let's see, energy stocks, that was a really big push at one point in time. Index annuities was a really big push. Income riders on variable annuities was another big thing. So Wall Street will continually come up with something that you just have to have. You look at that article from late 70s. Older investors are avoiding stocks. And what are they doing? They're doing options contracts. There are all those things on options right now.
Right.
How to magnify your wealth. It's not an option. You need to own options. You need to learn how to trade these things. You need to learn how to trade penny stocks. How about that one right there?
Yeah.
I'm just trying to come up with things off the top of my head.
Well, now sports betting, frankly.
Oh, God, prediction markets.
And all that kind of stuff.
Yeah, prediction markets. Yeah, good point, Evan. I mean, so there is no end to the stuff that Wall Street would just love for you to do, because they make a ton of money doing that. I think about, I think it was Fama's story where he goes down to Wall Street and they're pointing out the broker's yachts in the harbor. And he goes, well, where are the clients' yachts? Point well made.
Right.
There are people out there that will try to sell you just about anything, and recognize if they're telling you this thing's going to go to the moon, you need to own it. Ask yourself this: if this is going to the moon, why are you telling me? Why don't you keep that information to yourself? Why are you trying to get me to buy this thing that is supposedly going to go to the moon? Are you really that concerned about me?
Yeah. Go get a home equity loan and buy it. Put your house up for hock and go buy it.
Absolutely. Yeah.
Right.
Yeah. Leverage the daylights out of everything you own, for sure.
Wow.
Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds, there are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right, we're back here on the Investor Coaching Show. Paul Winkler, Evan Barnard. Yeah, so one of the things that we do around here is educate, because we believe that the educated investor doesn't get taken advantage of. That is my story. I'm sticking to it. We've been in this business a long time. We've seen an awful lot of stuff come and go. One of the more recent things that's coming our way, we've talked about this a little bit in the past, 401ks. We're adding private equity to 401ks.
Oh, boy.
Yeah. Another one of those things that Wall Street, they love it. Yeah, there was a whole thing about private equity, trouble with private access to public access to private markets. An interesting commentary in the Wall Street Journal about this very, very topic. And it says, while public stock market shrinks, if we look at the number of companies in the United States, the number of companies have come down. You have lots of companies. That's another reason you want to make sure that you're internationally diversified. The number of companies around the world has come down. But if we look at international markets, we have a big group of companies outside the U.S. Now, the difference between a public stock market is that all the information is public. And you go back to the Great Depression and say, why was the Great Depression so great in a bad way? A lot of it had to do, there were a lot of reasons, but one of the reasons was that you didn't have great information about companies. When you bought them, you didn't really know what you were buying. I mean, I didn't know what the earnings were going to be. I didn't know what the assets were because the information was private. Well, what happened is throughout history, and again, having been a broker for so many years, myself, Evan, Arlene, Jonathan worked for the banks. We look at, Jim having come from the investment industry, and all of us, every one of us that runs offices around here in Middle Tennessee, we've all have that background, and we've just been really jaundiced simply because of what we have seen and what we have been told to sell and how it turned out, and how many things that we have seen that have come and gone that were supposed to be the answer, only to be frustrated and see our clients get burnt. Well, that's why we spend so much time on here educating. Well, the latest thing coming around is private equity. Well, they said that this one guy writing this article, let's see, who is this? Hunter Lewis. Yeah. Says that now small investors may be invited into private deals, but probably only second-rate ones for confiscatory fees. Is this what we want? I remember a guy talking to me on a plane. He does the same thing that we do, Evan, in a different part of the country, in California. And he was sitting in pension meetings in California. And they were talking about this very thing, that a lot of these private equity deals are just absolute garbage.
Yeah.
So a lot of the pensions even were running away from it. And I think it's ironic the pensions were going, we got burnt by this so badly. Hey, let's just give this to the private investor. So he says, total venture capital in the United States amounted to only $400 million a year when I began my career, but I recommended a venture capital fund, the Yale University, 1976, and finding alternative investments to the clients, blah, blah, blah. He says, it accelerated institutional investing toward illiquid alternatives for a long time horizon. Well, the reality of it is a pension, even though they got burned, they could get away with it because they didn't need the liquidity. The average person needs liquidity in their portfolios. I need to be able to turn my money or turn my investment back into cash for spending in retirement. Now, Warren Buffett's partner, Charlie Munger, had this whole thing about including, he said he criticized the layering of fees, 2% annual plus 20% of profits or higher fund fees, and a proliferation of fund-to-fund consulting and outsourced chief investment officer fees. So he's basically saying, hey, look, these guys are making money hand over fist selling this stuff to you, the public. So they love it. Wall Street loves this stuff. It's great for them. Makes a lot of money for the investment industry. It gives liquidity to the private equity market. Imagine if you've opened up this huge sum of money in 401k plans. You've opened this up where public money in 401k plans is now accessible for private markets. What does that do for them? It lowers their cost of capital. It lowers what they have to pay to use your money. So you're thinking, oh, I've heard that they have higher returns on some of these things.
Yeah.
I've heard that they have higher returns. Why did they have higher returns? Because they had to pay more because they didn't have access to as much capital. Now, all of a sudden, if you give them access to capital, your money, in other words, what happens to the cost of using your money? It tends to go down. So all of a sudden, now this reason that you invested in this thing, because you're going to make big bucks, you're going to make a lot of money. And now all of a sudden they've got access to lots of capital. But here's the problem. They still don't have to give you information because it's private. Hence the word private equity. And there have been news articles recently talking a lot about private credit. I don't know. Have you seen any of this stuff, Evan?
Some, yeah. Well, I think some of them have gotten hammered recently.
Exactly.
Yeah.
Yeah. And that is the problem you run into. You're taking these huge risks.
Yeah. Just briefly, because it's the power of language.
Yes.
Is private equity, private credit sounds cool or mysterious. Mm-hmm. It would be much more honest if people said unregulated equities or unregulated credit. That would communicate more of what's really going on. Mm-hmm. And I don't think it would have as much appeal. Would you like to put this, put 10 grand in this unregulated equity? No.
Well, and likewise, I'd much rather invest in a high yield bond.
Yeah, right. Instead of a junk bond.
That's right.
Language has power.
Yeah, it sure does. That's marketing.
Right.
So often what we name something, it's like Congress names bills. I love the way they name bills, right?
OBBBA. That's probably the worst named bill in a while.
It's the Save the World Act,
right?
Or whatever. They'll have some name for a bill, and you go, wait a minute. It's what the Fiscal Responsibility Act of, whatever. I'm just making up stuff, but you hear these names, and it's like the marketing department gets a hold of Congress and says, hey, if you guys want to pass this thing, you got to sell the public on it. If you give it a good name, that's going to get it for you. So yeah, for sure. So it's frustrating for us, when we look at these types of things, we go, oh gosh, how do you protect the investor from these types of things? Education. I mean, that is really what it gets down to. How do markets work? Where do you have what have the returns been of investors? We talk about this all the time, the Dalbar research. The Dalbar research goes back 35 years now, more than that, I think, Evan, something like that. The Dalbar research on investor returns.
I bet it's over 40 at this point.
Is it up to
I think
past
so.
Over 40? Gosh, I guess that would probably be true
85.
Because I remember talking about the Dalbar research in the late 90s. I was talking about this research. Yeah. And they have research on what investors have gotten investing in the stock market, what investors have gotten in asset allocation funds, dividing between stocks, bonds, and cash. And what you'll find is that the return of the investor, this is key, in stock markets, in investing markets, has been around the inflation rate over that period of time. Now, over the same period of time, you had significant returns in markets, but people did not benefit from it. Why? It is because of these fads. I'm telling you, it is because people don't know what they're doing, why they're doing it. They don't understand these things, and they get pulled in by stories, and their greed gets used against them. People will tell you, you're going to make a boatload investing in this thing, whatever it is. And the reality of it is that these things come and go. But if we look at markets historically, going back 100 years, it's large, small, value, growth. Much more interesting story. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.